Welcome to this training module on lease accounting standards, where we dive into the key differences between IND AS116 and IFRS 16. These standards have reshaped how leases are reported, especially by lessees, and it's critical for finance professionals to understand both their conceptual alignment and practical deviations. Our agenda for this session covers an introduction to both standards, their scope, definitions, and specific aspects like lease term, transition approaches, and practical experience. We will also delve into discount rates, foreign currency leases, and presentation requirements. We will discuss on the core comparison between IND AS116 and IFRS 16 in this section. Our primary objective is to highlight the key differences in lease accounting between the two standards. While they share many principles, specific adaptations exist that are important to recognize. In this part, we'll provide a brief introduction to both lease accounting standards. This will help establish a foundational understanding before we dive into the more intricate details. Our objective is to help you understand the similarities and key differences between the two standards. This session is designed for accountants, auditors, controllers, and other finance professionals. Now let's proceed. This section offers an overview of these significant accounting standards. We'll discuss their origins and fundamental objectives in the realm of lease accounting. IFRS 16, issued by IASB, became effective on January 1, 2019, while IND AS116, issued by MCA, followed on April 1, 2019. Both standards share the common goal of bringing most leases onto the balance sheet, utilizing a right-of-use asset and lease liability model. Here we will examine the scope and definitions of leases under both standards. Understanding these foundational elements is crucial for proper application. Both standards share a common definition of a lease: the right to use an asset for a period in exchange for consideration. IFRS 16 has a global scope, whereas IND AS 116 specifically excludes biological assets and aligns with local Indian practices. Let's discuss the lease term and enforceability aspects under both standards. These elements significantly impact the calculation and recognition of lease liabilities. Under IFRS 16, a lease includes all periods where extension is reasonably certain. But in AS 116 places stricter legal emphasis. If either the lessee or lessor can terminate without a significant penalty, it may not qualify as a lease. This distinction impacts how Indian companies evaluate and record uncertain or flexible lease arrangements. This is a more conservative stance rooted in enforceability rather than business intent. In this section, we explore the transition approaches permitted by both standards. Companies have varied options when adopting these new standards. Both standards permit full retrospective and modified retrospective adoption. Under IND AS116, additional disclosure requirements apply if a company uses the modified approach, such as a reconciliation of lease commitments versus liabilities recognized. Under IND AS116, additional disclosure requirements apply if a company uses the modified approach, such as a reconciliation of lease commitments versus liabilities recognized. The Indian standard also features more detailed regulatory guidance, reflecting local compliance expectations. Now we'll focus on practical experience. These are simplifications allowed by the standards to ease the burden of implementation for certain types of leases. To ease adoption, both standards offer practical experience. IFRS 16 offers clear low-value and short-term lease exemptions. IND AS 116 allows similar relief, but doesn't define low value as precisely. This means companies need to exercise judgment and often refer to IFRS guidance or seek regulatory opinion. Now, we will discuss the differences in discount rates used for lease accounting. The choice of discount rate can significantly impact the valuation of lease liabilities. Both standards require lease liabilities to be discounted using either the interest rate implicit in the lease or the lessee's incremental borrowing rate. In practice, IND AS 116 leans heavily on the second, due to the difficulty in obtaining implicit rates in Indian contracts. Companies must carefully document how their incremental borrowing rate is derived, factoring in tenure, security, and economic conditions. Now let's examine the treatment of foreign currency leases. This is an area where specific differences between the two standards can have a notable impact. This is a major difference. under IFRS 16, any foreign exchange differences on lease liabilities must go to profit and loss. IND AS116 offers a concession via Para D13A of IND AS101, allowing Indian companies to capitalize these exchange differences as part of the ROU asset. This reduces P&L volatility, which is significant for companies with long-term foreign currency leases, especially in sectors like aviation, manufacturing, and IT. We will now discuss subleases and lease modifications. While the accounting principles are largely aligned, there are some specific considerations. While sublease and modification accounting is largely similar between both standards, IND AS116 requires more disclosures, particularly during modification assessments. The Indian standard often demands more detailed reporting in annual financial statements, particularly when lease modifications affect classification or valuation of liabilities. Let's now cover presentation and disclosures. This section highlights how lease information is presented in financial statements and the required accompanying notes. The Indian standard often demands more detailed reporting in annual financial statements, particularly when lease modifications affect classification or valuation of liabilities. Presentation formats differ too. IFRS 16 follows a global model, often aligned with SEC or EU formats. IND AS 116 demands compliance with formats laid out by the Ministry of Corporate Affairs in Schedule 3. Further, Indian companies must often disclose reconciliation from operating lease commitments to liabilities and explanations of transition adjustments. This ensures transparency for auditors, regulators, and investors. The key takeaway: while IFRS 16 guides global practice, IND AS 116 adds disclosure depth, enforceability emphasis, and local regulatory alignment. To summarize, key differences include scope, where IND AS 116 excludes biological assets. Transition disclosures are more mandatory under IND AS 116. Foreign exchange lease liability treatment differs, with IND AS 116 allowing capitalization. Finally, enforceability under IND AS 116 emphasizes legal aspects. Both standards aim to improve lease transparency and comparability. IND AS 116 is conceptually aligned with IFRS 16 but tailored to India's legal and economic framework. We extend our sincere thanks for your participation in this training session. Thank you for your attention. If you have any questions or feedback, please feel free to reach out. You can also contact us at unlearntr@gmail.com for a free, in-depth training session tailored for your organization.